Welcome everyone. I am absolutely thrilled to have you here for this explainer. Today we're going on a gamified journey to master the absolute core of business finance, which is the accounting equation. We are going to tackle this by conquering progressively tougher challenges, honestly kind of like leveling up in a video game. We'll start with the absolute basics, and by the end of this, you'll be decoding complex, real-world transactions like a total pro. So grab a mental notepad, play along with me, and let's see how high you can score.
Okay, let's dive into this. Think of our agenda today as a level map. We'll kick things off with level 1, the foundation. Then level 2, identifying the pieces. After that, level 3, doing the math. Then things get really interesting in level 4, real-world transactions. And finally, we'll top it all off with level 5, the expanded equation.
All right, level 1, the foundation. Get ready to play along here. So I'll put the question directly to you first. What is the basic accounting equation? Go ahead and lock in your answer. Just think about the fundamental relationship between what a business owns, what it owes, and what actually belongs to the owners. You got it?
Assets equal liabilities plus equity. If you got that, excellent start. This formula is literally the bedrock of the double-entry accounting system. And the golden rule here, the one you can never forget, is that this equation must always balance. Always. If your assets don't perfectly equal your liabilities plus your equity, well, that immediately tells you there's an error hiding somewhere in your accounting records.
To put this into a real-world perspective, let's talk about the balance sheet. You know, a balance sheet isn't just some random list of financial numbers, it's actually a visual representation of this exact equation in action. It gives you a perfect snapshot of a business's assets, liabilities, and equity at one specific moment in time. So really, if you understand the equation, you already understand the balance sheet.
Moving right along to level 2, identifying the pieces, because knowing the formula is only half the battle, right? We need to know what actually goes where. So here is your level 2 challenge. Take a look at these two notoriously tricky terms from our source material: prepaid expenses and accounts payable. Are they assets or are they liabilities? Take a second to mentally categorize them. They sound like they might be doing the same kind of thing, but don't let the names fool you. And this brilliantly illustrates how easy it is to get tripped up if you're not looking closely. Prepaid expenses are actually a type of asset. Why? Well, because they represent payments you've made in advance for goods or services you'll get down the road. It is a future economic benefit for you. On the flip side, accounts payable is a liability. That represents money the business currently owes to its suppliers. You have a strict obligation to pay them later. So they sound similar, but they sit on completely opposite sides of our equation.
Okay, level 3, doing the math. Don't worry, it's just some basic algebra to find the missing pieces.
Here is your first scenario. Let's say a business has $50,000 in assets and $20,000 in liabilities. What is its equity? Run those numbers in your head real quick.
The answer is $30,000. To figure this out, all we really have to do is rearrange our foundational formula. Instead of assets equals liabilities plus equity, we just flip it to equity equals assets minus liabilities. This is also known as your net assets. So $50,000 minus $20,000 leaves us with exactly $30,000 in equity. Easy enough, right?
Now let me challenge you with the slightly trickier math problem directly from the source material. Pay very close attention to these numbers. A business has total assets of $80,000, but total liabilities of $110,000. What is its total equity? It is negative $30,000. Yeah, if you take $80,000 in assets and subtract $110,000 in liabilities, you drop below zero. And this highlights a vital concept: negative equity. This literally means the business currently owes more to external parties than it actually owns. And as you can probably imagine, that is a highly risky financial position to be in.
All right, level 4, real-world transactions. This is the climax of our explainer, where we finally see the equation in constant dynamic motion.
Because, business never just stands still. So the question is, how do daily business moves, like buying equipment, taking out cash, or paying bills, actually affect this balance? Well, every single time a transaction happens, the scales tip and the accounting equation has to instantly adjust to stay perfectly balanced. Let's do a rapid-fire review of how this works.
Now, what's really interesting about this slide is how it perfectly proves the unbreakable rule of double-entry accounting. Let's just walk through it row by row. If an owner contributes cash, well, your assets increase, and your equity increases because the owner's claim on the business just grew. But what if the owner withdraws cash? Assets decrease and equity decreases. Simple. Now, what if you buy $3,000 of equipment on account? Your fixed assets go up, but because you haven't actually paid for it yet, your liabilities go up by the exact same amount. Finally, if you pay off a $1,500 account payable, your cash, which is an asset, decreases, but your outstanding liability also decreases. Notice how in every single scenario, the left side always matches the right side. It's beautiful, really.
Now listen carefully to this one, because it is the toughest transaction question from our source material. Let's say a business sells goods for $1,000 cash, but those goods originally cost the business $700. How exactly does this specific transaction affect the accounting equation? Think about all the moving parts here.
Okay, let's break down the net effect. First, making that sale increases your cash by $1,000. Great, but at the same exact time, you have to actually hand over the goods to the customer, which reduces your inventory asset by $700. So the net effect on the asset side is an overall increase of $300. But wait, what balances the other side? Well, that $300 difference is your profit, and that profit flows straight through your retained earnings, right into equity. Boom, the equation is perfectly balanced.
Huge congratulations, you made it to the bonus round. Level 5, the expanded equation.
Up until now, we've kind of treated equity like a single, solid block. But to truly master the game, we have to ask, what are the specific components hiding inside the word equity?
So the crucial point is that equity is not just one simple number. It's more of an umbrella term. In the expanded accounting equation, equity is broken down into all its moving parts. It includes the capital contributions from owners, the revenue the business brings in, the expenses it has to pay out, the dividends it distributes to its shareholders, and of course, its retained earnings, which are the accumulated profits kept in the business over time. By breaking equity apart like this, you get a much deeper, richer view of exactly how a business is actually performing.
And just like that, you've beaten all 5 levels. Now, accounting takes real practice, so don't sweat it if you didn't get every single mental question perfect on the first try. Take a beat and try to apply this to the real world. I want to leave you with this final thought today. If your own business's accounting equation, or even a case study you're working on for school, doesn't balance right now, what error is hiding in your records? Remember, the math never lies. Thank you so much for joining me for this explainer. Keep practicing those fundamentals, and I'll see you next time.